At 28 years old, Daniel had finally reached a number he had been chasing for years. $50,000. It wasn't inherited. Nobody handed it to him. He didn't win it. He built it one paycheck at a time. For years, Daniel had lived differently from the people around him. While his friends were taking expensive vacations, he was staying home. While others upgraded their cars, Daniel kept driving the same used sedan. Every payday, before he could convince himself to spend the money, he moved part of it into savings. It wasn't glamorous, but slowly, the number grew. $10,000, then $20,000, then $30,000, and eventually, $50,000. Daniel stared at the balance on his phone one evening and smiled. For the first time in his life, he felt like he had something powerful. Not enough to retire, not enough to quit his job, but enough to change the direction of his future. And then he faced the question that every person who saves money eventually has to answer. What should I do with it? Daniel had spent years hearing the same advice. Buy real estate. Stocks are the easiest way. Real estate makes millionaires. Just invest in the market. Never put all your money into one property. Stocks are too risky. Everyone seemed to have an answer. And somehow, every answer contradicted the one before it. Daniel wanted to know the truth for himself. So instead of choosing one side, he decided to experience both. He had no idea that the decision would change the way he thought about money for the rest of his life. Daniel had always liked the idea of real estate. Maybe it was because real estate felt real. A stock was just a number on a screen. A house was different. You could walk through it, touch the walls, stand in the backyard, look at the neighborhood, and if someone rented it, money could come in every month. It felt like an investment he could understand. So Daniel began studying the local housing market. He spent evenings comparing properties. He looked at neighborhoods. He calculated mortgage payments. He studied rental prices. Eventually, he found a modest $250,000 house in a decent neighborhood. Nothing luxurious, nothing impressive, but it had good rental potential. Daniel had $50,000, exactly enough for a 20% down payment. He knew taking on a mortgage would be a major commitment, but he also understood something important. With $50,000, he wasn't just buying $50,000 worth of real estate. He would be controlling a $250,000 asset. That was leverage, and leverage was powerful. So Daniel made the decision. He bought the house. The mortgage was approximately $200,000 at a 7% interest rate, giving him a monthly payment of around $1,330. For the first few weeks, Daniel wondered if he had made a terrible mistake. Then he found a tenant. The tenant agreed to pay $1,800 a month. Daniel opened his spreadsheet. $1,800 in rent, minus roughly $1,330 for the mortgage. About $470 left. Daniel leaned back in his chair. He smiled. For the first time, he could see how people became wealthy through real estate. Someone else was helping pay his mortgage every month, and every payment was slowly increasing his ownership of the property. He thought, this is how wealth works. But Daniel was about to learn that spreadsheets can make investing look much easier than real life. The first few months were almost perfect. Rent arrived. The mortgage was paid. The property appeared to be increasing in value. Daniel would sometimes drive past the house after work. He would look at it from the street and think, I own that. The feeling was different from anything he had experienced before. He wasn't just saving money anymore. He owned an asset. But then, one Saturday morning, his phone rang. The tenant had a problem. A plumbing issue. Daniel spent the weekend finding someone to fix it. A few months later, something else broke. Then came a vacancy. The tenant moved out. Suddenly, $1,800 that Daniel had expected that month never arrived. But the mortgage didn't care. The bank still wanted its payment. Daniel began realizing something. The rent wasn't his profit. It was revenue. And there was a long list of people waiting for their share before the remaining money reached him. Taxes, insurance, maintenance, repairs, vacancies, advertising, and sometimes, his own time. After 3 years, Daniel looked back at the numbers. On paper, the property had generated tens of thousands of dollars in rent. But after expenses, the actual cash he had kept was far smaller. The house was still building equity. It was still appreciating. But the dream of effortless passive income had disappeared. Real estate wasn't passive. Not for him. Not yet. And that's when Daniel started asking another question. What would happen if I invested differently? Daniel didn't sell the house. He wasn't ready to give up on real estate, but he wanted to experience something else. So he started learning about index funds. The idea seemed almost boring. Instead of buying one house, he could buy tiny pieces of thousands of companies. No tenants, no plumbing, no roof, no property manager, no mortgage, and no single neighborhood determining his financial future. Daniel opened a brokerage account. He invested another $20,000. Then he set up an automatic contribution of $200 every month. And then, nothing happened. At least, that's what it felt like. He went to work, came home, paid his bills, and every month, $200 disappeared from his checking account and went into his investment account. There was no house, no tenant, no rent check, no physical evidence that anything was happening. Daniel almost forgot about it. But the market didn't forget. While Daniel slept, his investments were working. Some months, the balance went up. Other months, it went down. Sometimes the market dropped sharply. Daniel learned what volatility felt like. One morning, he opened his phone and saw that thousands of dollars had disappeared from his portfolio. Nothing had physically broken. Nobody had called him. No tenant had moved out. But his money was suddenly worth less. His first instinct was to sell. Then he remembered why he had invested. He closed the app and waited. That decision would become one of the most important financial decisions of his life. A decade passed. Daniel was now 38. His life looked completely different from the man who had first opened that $50,000 savings account. The rental property had survived. So had the stock portfolio. But Daniel had learned that neither investment behaved the way people on the internet had promised. The house had appreciated. His mortgage balance had fallen. His equity had grown substantially. At one point, the property was worth somewhere around $350,000. Daniel had built serious wealth through it. But he had also spent years dealing with repairs, vacancies, insurance, taxes, contractors, and unexpected expenses. He had learned that leverage could make a good investment powerful, but it could also make a bad investment painful. Then he checked his investment account. The index fund had grown to somewhere around $170,000 to $180,000, depending on market performance. He had continued contributing every month. No dramatic decisions. No attempts to predict the market. No jumping into whatever stock was trending. Just consistency. And something strange had happened. The growth in the account was becoming larger than the money Daniel was personally adding. That was when he finally understood compound growth. At the beginning, Daniel had been doing most of the work. His contributions created the growth. But eventually, the money itself started doing more of the work. His gains generated gains. And those gains generated more gains. The snowball was finally getting big enough to move on its own. Daniel sat at his kitchen table one evening and looked at both investments. The house had made him wealthier. The stock portfolio had made him wealthier. But they had done it in completely different ways. The house demanded his attention. The index fund demanded his patience. And Daniel realized something. The return on an investment isn't the only return that matters. One evening, Daniel calculated how much time he had spent managing the property over the previous 10 years. Tenant calls, property inspections, contractors, repairs, messages, vacancies, research, paperwork. He had never included those hours in his return calculations. But now he did, and the number bothered him. The property had made money. There was no question about that. But it had also consumed pieces of his life. Then Daniel looked at his index fund. How many hours had it required? He thought about it. Almost none. He had spent more time worrying about the market than actually managing the investment. That realization changed the way he thought about wealth. Before he had asked, which investment makes more money? Now he asked, which investment gives me the best combination of money, time, risk, and freedom? That was a much harder question, and a much better one. Then came the year that tested Daniel's patience. The stock market crashed. His portfolio dropped dramatically. Years of savings seemed to disappear in a matter of weeks. Daniel felt sick. He opened the app, closed it, opened it again. The numbers were still there. Lower. Much lower. For the first time, he understood why people panic during market crashes. It's easy to say you're a long-term investor when prices are rising. It's much harder when your account is falling every day. Daniel thought about selling. He could take what remained and move the money somewhere safer. Maybe back into real estate. Maybe into cash. Maybe somewhere he couldn't watch it disappear. But then he remembered what he had learned. The stock market was never supposed to move in a straight line. So Daniel did something that felt completely unnatural. He kept investing. $200 every month, even while the market was falling. And eventually, the market recovered. Then it recovered some more. And eventually, the portfolio reached new highs. Daniel had just learned another lesson. Volatility is the price you sometimes pay for long-term growth. By the time Daniel turned 48, 20 years had passed since that evening when he first saw $50,000 sitting in his savings account. He opened the spreadsheet he had created years earlier. The rental property was now worth approximately $500,000. His mortgage balance had fallen dramatically. His equity was around $385,000. And over 2 decades, the property had generated substantial rental income. After accounting for expenses, Daniel had earned roughly $120,000 in net cash flow. It had been a successful investment, but it had never been effortless. Then he opened his investment account. His original investment, combined with 2 decades of $200 monthly contributions and long-term market growth, had grown to approximately $518,000 under the assumed 10% average annual return. Daniel stared at the number. He had personally contributed around $98,000 over those 20 years. More than $420,000 had come from growth. He sat quietly for a moment. 20 years earlier, he had believed the biggest advantage of investing was finding the right asset. Now he understood something different. The biggest advantage was time. Daniel thought back to the 28-year-old version of himself. That younger man had wanted certainty. He wanted someone to tell him exactly what to buy. He wanted the investment that couldn't lose. He wanted the strategy that would guarantee wealth. But Daniel now understood that such an investment didn't exist. Real estate had taught him the power of leverage. With $50,000, he had controlled a $250,000 asset. That leverage had helped him build equity faster. But leverage also came with debt, concentration risk, maintenance, vacancies, and responsibility. The stock market had taught him something completely different. Diversification, liquidity, simplicity, and perhaps most importantly, compound growth. But stocks had demanded something from him too. Patience, emotional discipline, and the ability to watch his portfolio fall without abandoning the plan. Neither investment had been perfect. Because no investment is. Daniel finally understood why so many arguments about real estate versus stocks go nowhere. People ask, which one is better? But that's not the right question. The better question is, which one is better for me? If you want leverage, real estate may make sense. If you want diversification and liquidity, stocks may make more sense. If you enjoy managing properties, real estate might fit your personality. If you want your investments to require almost no attention, index funds may be a better fit. And if you have the knowledge, capital, and risk tolerance, there's no rule saying you have to choose only one. Daniel didn't. He experienced both. And that's what taught him the lesson no spreadsheet could teach. 20 years earlier, Daniel thought wealth was about finding the perfect investment. Now he knew better. Wealth wasn't about finding one magical asset. It was about understanding the complete equation. The return, the risk, the leverage, the taxes, the expenses, the time, the stress, the liquidity, the opportunity cost, and most importantly, the ability to stay invested long enough for the strategy to work. A rental property can make you wealthy. An index fund can make you wealthy. A business can make you wealthy. But none of them can do it if you constantly jump from one strategy to another. The investment that looks perfect on paper means nothing if you can't stick with it. Daniel had spent 20 years learning that lesson. And if he could go back and speak to his 28-year-old self, he wouldn't say, buy real estate. He wouldn't say, buy stocks. He would say, understand what you're buying. Understand what it costs. Understand what it demands. Understand what can go wrong. Understand what you're giving up. And then choose the strategy that fits the life you actually want. Because the goal of investing isn't simply to end up with the biggest number. It's to build wealth without sacrificing the life you're trying to build in the process. Daniel had started with $50,000. 20 years later, he had much more than money. He had something more valuable. Experience. He had learned that leverage can accelerate wealth. That compounding can quietly transform it. That markets can test your emotions. That real estate can consume your time. And that the best investment isn't always the one with the highest theoretical return. Sometimes, it's the one you can understand. Sometimes, it's the one you can survive. And sometimes, it's the one that lets your money grow while you get back to living your life. So the next time someone tells you, real estate always beats stocks, or stocks always beat real estate, don't ask them which one won. Ask them, did you include everything? Because when you include everything, the answer becomes much more interesting. And that is the real story of building wealth.